In this video, we master the full execution life cycle of the long call strategy. Successful entries require more than just a bullish chart pattern. You must assess implied volatility rank to ensure you aren't buying inflated premiums. Ideally, enter a long call when IV is low relative to historical data, positioning yourself to benefit from both directional movement and potential volatility expansion. If IV is in the upper percentile, consider spread strategies instead to mitigate the risk of IV crush. As the stock moves in your favor, gamma increases your delta, accelerating gains, but theta is constantly working against you. Therefore, set profit targets based on technical resistance levels of the underlying stock rather than arbitrary percentage returns on the option premium. This aligns your exit with market structure rather than the derivative's fluctuating pricing model. For risk management, avoid placing stop-loss orders on the option premium itself, as wide bid-ask spreads and momentary volatility spikes can trigger premature exits. Instead, execute a manual exit when the underlying stock breaches a key support level or violates your original bullish thesis. This creates a mental stop based on the asset driving the value, not the decaying contract. If the trend remains strong but your expiration is approaching, you must manage the position by rolling. Rolling out involves selling your current call and buying a later expiration to reduce theta decay, giving the trade more room to breathe. Alternatively, you can roll up by moving your strike price higher to lock in realized profits while maintaining directional exposure with less capital at risk. Finally, respect the time decay curve. Theta accelerates rapidly in the final 30 days before expiration, eroding value even if the stock stays flat. Plan to exit or roll your long call before this acceleration phase begins, typically around the 21-day mark. Holding a naked call through earnings or into expiration week without a specific hedge is essentially gambling due to binary risk. Thanks for watching, and stay tuned for our deep dive into long puts.